Hey, good morning, everyone. Marty Mazur here. It's Thursday, the 11th of January, 2024. Thought I'd pop in and get today's market update recorded while I had a few minutes. Clients, this will come in a link tomorrow morning as Friday's message. And I think tomorrow, looking at my calendar, I should be able to get the weekly economic update out to you, which will be interesting because, as I said in this morning's note, I'll be pouring through today's CPI data for you, along with any other updates that are worthy of commentary on the economy. So this morning in the written notes, I actually started it about a half hour before the open and then finished it just after the open. So early on, it was about a half hour after the CPI results came out, and I showed charts. In fact, I have the Russell 2000 up right now. And it was actually down about 60 basis points. So it was about right here. On the morning, you can see it popped up. Same thing, by the way, for the S&P and the NASDAQ. But when I started that commentary, the S&P was only down about 10 basis points, and the NASDAQ was down, I think, just flat, down 6 basis points. So again, the Russell 2000, and these are the futures, was down 0.6%. Now it's down 1.6%. So down nearly 3 times what that read is. In fact, the actual index itself is down 1.7% as I speak. S&P futures are down 84 basis points. So again, they're down a lot more than they were initially. The actual S&P cash index is down 0.77, and the NASDAQ 100 is down 0.8%, 80 basis points. So as apparently the market has digested this, I have not listened to any news since I wrote the blog this morning. Been doing other research that I normally do in the mornings. So right before I turned on the recorder, I looked at the headlines, and it just said that the market's melting off a little bit on hot CPI news. Well, as I expressed this morning, actually, core came down a little bit. That's supposed to be what everybody's concerned about, and that X's out food and energy. But the headline was up just a few ticks. It was 3.1% year over year at the end of November, 3.4% this morning for December, up 0.3% month on month versus just 0.1% for November. So definitely hotter on a headline basis. Again, they talk about core more so because food and energy is so volatile, despite the fact that it's where we spend all our money, right? And of course, the higher cost of food and energy over time does bleed through to other inflation data. Now, one of our research partners who does an incredibly deep dive on the world from a macro standpoint says that their inflation indicators have begun to bottom. And if they actually have bottomed and begin to turn up, well, of course, that's problematic. As I keep suggesting, the market, in a sense, we could have a great year this year again, but in a sense, it's between a rock and a hard place. If our indicators ultimately come to fruition, we don't have timing indicators, we just have condition indicators, and they say conditions suggest that a recession is not an unlikely event during the course of, the next several months. Let's say, again, I can't put a timeline on it necessarily. It just says that risk of that is high right here. That would actually see inflation come further down, and initially as that begins to happen and rates anticipate that tends to be bullish initially for stocks. And then, as I showed on the written blog, when there's a recession, you can forget about it, right? Falling interest rates do not buoy the stock market. I heard a commentator in the Asian session night before last make this point that, the Fed eases, that's a tailwind for stocks. And I thought, wow, you need to look at your charts again, and then add that if there's a recession, falling rates don't make any difference for the first half of it anyway. Okay, so in fact, let me just do that. So this morning, I showed this chart as well. And the yellow line is the S&P 500. These red shaded areas, those are recessions, very thin line here for the miracle recession that really never was because of all the money that came in. But notice, folks, here is the Fed cutting interest rates, right? And now the threat of that has been a real boost to the market, but this is before the tech bubble. Here is the Fed cutting interest rates, right? Heading into the real estate bubble, mortgage bubble bursting. Now, here's where the Fed stopped hiking, and look what the market did. Here's where the Fed stopped hiking, and look what the market did, right? Here's where the Fed stopped hiking before COVID, and look what the market did. By the way, our recession light was lit here before I could spell COVID, right? And then here is where the Fed stopped hiking, and look what the market has done, right, from here. Now, here is where the Fed started cutting, and look what the market did. Here's where the Fed started cutting, and look what the market did. Here's where the Fed started cutting, continued to rise, but then look what the market did. It was fascinating. While they were cutting, they were saying everything's in great shape. They just wanted to try to circumvent a recession. COVID actually getting the excuse, they said that, you know, this recession happened, it shouldn't have happened, it was all because of COVID. Well, their actions actually said something very different. And I was reading what their own economists were saying, and that jibed with our indicator, which said something different. But COVID gave the green light for trillions of dollars to get spent. Otherwise, that would have been tough to get through politically. Anyway, so we got this, and we got the inflation and everything that came with it. So here's my point, folks. You get it. If indeed the Fed starts cutting rates, particularly as aggressively as what Fed funds futures are still discounting, well, that tends to be consistent with a recession here, which tends to be consistent with falling stock prices. I don't know the outcome. I don't know the future, obviously. But what I do know and what we do know is the risk-reward setup. And from here and from valuations, if you go back and read through our year-end letter, these are just not conditions that are typically consistent with a brand new wave of growth in risk assets. It's actually the opposite. Now, the conditions could abate or clear, however we want to say that, amid these higher valuations, and earnings, start rising like crazy. Therefore, the valuations aren't so excessive, particularly in places like the big tech sector. And I will add that valuations are compelling in other places, and we've actually added some positions in those other places too. But overall, when you look at it across the board and you look at how influential and how concentrated the market is by these big tech stocks, you have to be careful, right? The S&P 500, I was looking at the hourly chart, so we'll just start there since that's what's up. So the hourly chart was actually kind of calling for this rally that we've had the last few days. You can see, these bullish divergences against this downtrend here, somewhat of a wedge pattern, right? You can see here on the hourly, it's rolling over pretty hard, right? That's a little sell signal right there, but we're not really concerned that much, certainly not the way we manage money with the hourly chart. Looking at the 1-year daily chart, and I'm not going to go there, but remember how bearish that weekly chart is. That is what concerns us right now. But this daily chart is nothing to write home about big time. So here we are right here at this high, which is pretty close to where the market peaked back in January of 2022. And this, folks, is just not a good look. And again, we could go up and forge new highs, wouldn't surprise me, but we're not going to be able to do it with a very good technical backdrop, to put it mildly. And here we are threatening that 20-day moving average. You break down below that, you get past this gamma flip line. Forgive me, but I mentioned in day before yesterday's video update, I mentioned options or derivatives and where dealers are positioned. There comes a point where if you break through a level, suddenly those who sold put options are going to have to be shorting stocks like crazy to hedge their downside risk. They lose money when the market goes down to the people who bought the puts from them. They have to hedge that position. and it can really exacerbate something to the downside, just like I think earlier in the week it was exacerbating it to the upside, looking at them being short calls and so on. And I know that gets into the weeds. I have spent a lot of time on it. Should be familiar to some of you who watch these videos religiously. Looking at the NASDAQ 100 index, essentially pretty much the same chart. You know, although it's a little losing, maybe even a little more so, its 20-day moving average. Not quite back up to the late last year top here, which is essentially right where the market topped in 2022, or actually for the NASDAQ, late 2021. But again, something to be concerned about, but absolutely in the near term, tomorrow's producer price index, maybe it'll be soft and maybe that'll inspire a big rally tomorrow. Remains to be seen. Yields, I said, have been problematic for the setup for stocks, and we saw a pretty bullish technical look at yields. And you might say that it was actually anticipating maybe a little hotter CPI today, and you can see yields are up a little bit today. If you want to be long stocks, you don't want that to be a bull flag pattern for yields. But yeah, so technically that makes perfect sense. And then the dollar, and I'll stop here. Same thing, a strong dollar in this environment is bearish for stocks. Dollar's up, as you can see, so far this morning. Again, lots to play out, pretty volatile stuff I'm showing you. Pretty short-term stuff. Clients, we're looking, much longer term than this. And we are continuing to have some defensiveness in our portfolio for obvious reasons if you're following us on the blog. Folks, I will leave it there. Hopefully tomorrow with an economic update for you. And if it makes sense, I'll maybe offer up a screen or two on the markets as well. Thank you as always for watching and listening. Talk to you very soon. Bye-bye.